Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Steve is with us around the table. Steve, good morning to you.
Good morning.
I'm going to ask it then. First question, who wins?
So, caveat first.
Okay.
I'm not speaking for Neuberger Berman. I'm speaking just for myself. Don't want to get into trouble. And what I'm about to say is just pure political analysis. And the analogy I'll draw is to the financial crisis. You know, in August of 2007, the subprime paper market collapsed. And at that point, when you look back on it, the financial crisis was baked. Everything else was completely inevitable. So I think that it is completely inevitable at this point that Donald Trump will win every single swing state and will get elected. And the reason I think this way will unfold is part one of this story is that the protesters in all the universities are becoming the face of the Democratic Party. But that's not 100% at this point. But what's going to solidify it is in August at the Democratic Convention, which is in Chicago, ironically, you'll see all these protesters again, and a lot of them will be screaming and yelling things like not just death to Israel, but death to America, because they can't help themselves. And the country will be appalled. And that'll be it. It'll be over at
Let's
that
say
point.
you're right. Crystal ball, dead on. Next question is, what do I do with that information, and when do I put the trades on? And what are the trades? How do you sort of go through that process?
I would say you do largely nothing. Because I don't think that whether Trump wins or Biden wins has any real impact on the economy at all. You know, there'll be things that people will want to trade, which I'm not going to talk about because I haven't put on those trades yet. Because it's too early. But there'll be things to do. But that'll just be short-term trades.
You touched on it there, Steve. Can I jump in? That's what I'm interested in. You said it's too early. When is the right time to really think about expressing these as trades?
Oh, I think when in August, when at the convention, when I said happens, everybody will realize that that's the case.
So you said that it doesn't really matter who gets elected.
Yes.
That's fascinating to me because some people are saying that Donald Trump would put on pretty significant tariffs, particularly to China, and that this would increase inflation, sort of de facto, in the United States. I see you rolling your eyes. You can respond in a second. And then at the same time, you're going to have, the tax cuts reinstated.
And cats and dogs will be lying together, and it'll be end of the world and doom, gloom, and whatever.
Well, cats and dogs lying together. Yeah. I don't know. It could be doom, gloom, depending on your view. But what do you make of this? Why do you discount this?
I mean, do I think that Donald Trump would increase tariffs to China? Sure. Do I think that would have a massive inflationary impact in the United States? I think that's ridiculous. So, on the margin, would it impact, for example, I'll give you a company, First Solar. So First Solar sells solar panels to utilities. Now, there are already massive tariffs that are helping them now. Could Trump increase the tariffs or make them longer so that stock would do better? Could be. But, are the price of T-shirts going to go up? Is the price of food going to go up? No. I mean, you have to remember that the United States is of all the developed world, the United States is the most insular economy of any developed world. So the fact that tariffs will go on in China, big deal.
But one thing you recently spoke about was infrastructure spending and how you like all of those trades.
Yes.
What happens to all of that if Trump becomes elected? Because all of that is attached to the Biden administration.
Well, true. But don't forget that the solar tariffs were put on by Trump originally. More than 50% of all the government spending is actually going to red states. So I don't think he's going to want to mess with his own voters. Could there be tinkering at the edges? Sure. Are there enough votes in the United States Senate to repeal the IIJ Act and the IRA Act? They're not even close. So, rhetoric, you'll hear lots of rhetoric about repealing the IRA or changing the IRA, and, stocks will move on that. But at the end of the day, nothing will happen.
So spending will continue.
Yes.
Tax cuts will get extended.
Yes.
Tariffs on the margin will be there.
Yep.
This, to me, raises questions that a lot of people have talked about, which is the deficit not going away. at the time where you're going to have to see some of the issuance numbers really start to pick up. You seem to discount that too. You don't think that necessarily...
100%.
Okay,
it's not an issue.
Okay, so you don't think the deficit's an issue?
It's not an issue. Can I tell you why? Look, I'm not an economist. I can only say this, that the people who have been complaining about the deficit, and I like to call them the deficit people, okay?
Because that's what it sounds like.
Because that's what they sound like, have been literally saying, the deficit for 40 years.
I know,
okay? 40 years. Now, look, in my business, being too early is the equivalent of being wrong. But in my business, when you're too early, you're a year too early. You're 2 years too early. You're not 40 years too early. When you're 40 years too early, you probably should just shut up and keep your mouth shut. But I would say this, that the sign that the deficit group will be right is when rates actually go up a lot. Until then, everybody should just keep quiet.
Well, but how do you know when that's going to happen?
Well,
right?
you'll see it.
But are we getting close to that point?
We'll be on the show and you'll say, wow, long-term rates went up 50 basis points in one day.
That deficit.
And then they will say
so natural
they were
coming out of your
finally
mouth.
right after 40, 50 years. Until then, it's not relevant.
Well, but this to me is a real question because people increasingly are focused on this in the market. People who actually can determine what those rates are can send those rates to up 50 basis points in one day.
And are they selling treasuries?
Well,
are rates going up?
There was a time when they were.
They're talking and they're doing nothing.
So you think, are you basically saying that you are long-term rates because you think that all of this discussion about the deficit is still way too early and all these people are going to be proven wrong?
That's going to become a meme now.
I hope so.
And I literally just made it up.
Well, that's fantastic. It's really good. So answer the question.
I lost the train of thought.
Okay, well, I'm just saying, if at what point do you say, okay, if we think that the discussion of the deficit is overblown, go into long treasuries, buy them, because all the people who are worried about that are going to be proven wrong.
Well, I mean, look, I'm not really a bond person. I'm more of a stock jockey. So, what caused the market to go down in 2022? The Fed raised rates 500 basis points. I don't think the Fed's going to be raising rates. Do I think the Fed's going to cut rates? Maybe. I actually don't think it doesn't really matter because even if they cut, they're only cutting a little bit. They're certainly not cutting 500 basis points. People like to talk about it on Fed Day as if, Moses came down from Sinai with the tablets and let's examine whether the 10 commandments are on there because we'll look at whether there was a comma removed. That's so significant. Let's buy the S&P,
I've been missing out. He wears a bow tie and he sits right there.
He said wow, what does that mean? So
then how do
So you know what? It's not relevant.
Okay, so you don't necessarily see the potential rate cutting cycle as particularly relevant to your stock picking. At the same time, we've seen...
there is no aggressive rate cycle cutting. That would matter. If the Fed's going to cut rates once, twice, to tinker at the edges...
We can live with 5%. Is that the message? We can live with 5%.
Well, we seem to be living just fine with it right now.
Yeah.
The economy's fine, which I think is a surprise to everybody.
It raises an important question. I was listening to the podcast you did with Tracy and Joe. It was fantastic, by the way. And if you haven't listened to it at home, you should do. Odd lots. And you talked about good times is for storytelling, bad times is for the focus on a balance sheet. Is this a good time or a bad time?
This is definitely a good time.
It's a good time.
And I'll just repeat what I said on that show because I like it. Is that there are three great themes of our time. There's AI, there's everything having to do with infrastructure, and there's crypto. And I believe in the first two, and I don't believe in the third.
Why not the third?
Look, there's two questions with respect to crypto. Is it a currency? And if it's a currency, should you own it? So let's skip the first part, but that's like is it a currency is like having a discussion about how many angels dance on the head of a pin. There's no structure to it. So, okay, so if it's a currency, why should you own it? So let's ask the people who own crypto, why do they own it? They all say the same thing. They say, fiat currency, the deficit people. It's definitely going to be a meme.
We're trying.
I created my first meme.
Not yet.
And it's a hedge against the demise of fiat currency. Cats and dogs one day will lie together. You'll be in a cave, but at least you'll have your crypto. It's like digital gold. That's the thesis. So, okay, let's take them at their word. So if that's the thesis, then on days where everybody's worried about inflation, they're worried about the deficit, and NASDAQ is down 300 points, and interest rates are up, crypto should be up. And on days where everybody's feeling great, NVIDIA's up and NASDAQ is up and rates are down and nobody cares about inflation, crypto should be down. And does it act that way? It does not. It acts exactly the opposite of its own thesis. Its correlation to NASDAQ is like 75%. So to me, it's just another way for people to speculate on speculating. So why do I do that? There's no data point of research that says that it's right or that it's wrong.
So at this point, you don't like crypto, debt, whatever.
I never have, but I'm not short it. I don't short it because there's nothing to short.
How do you get an edge at a time where everyone loves AI? And where everyone's scouring for the plays that are best to expose them?
I'll just give you one example of a stock that I think eventually will become a great AI play, which, I mean, the whole thing about getting an edge, I think, is overrated because most people have all the facts. It's a question of how you interpret the facts. I mean, people think that I had some sort of unbelievable edge about the subprime mortgage sector. I had the same facts everybody else had. I just looked at them differently. So, you know, right now everybody's focused on NVIDIA and AMD and data centers, but one day, and that day is not too far from now, there'll be a lot of AI apps that you and I will use. And we're not going to use them at a data center in the cloud. We're going to want to use them on our phone because we want it at the head end, right here. So at that point, there's going to be, I think, an entire new sales cycle of phones, laptops that are going to need to be upgraded to be able to do all this stuff that eventually we will want to do. So that's Apple.
So you're buying Apple aggressively?
Well, we've owned it for a long time, and we continue to own it. Now, but it's not actionable at this second because there hasn't been an app. What app? I don't know. When it shows up, I'll let you know. But until then, but at that point, the phone. I have the new phone. That phone is not going to be probably not going to be capable to do some of the apps that you're going to want to do.
It appears that's the direction of travel. I know you've talked about this in the past. I'd love to hear it again. The electricity grid.
Yes.
The demand on electricity in this country, given where policy is, EVs, where AI is going, how great is it going to be? Are we in a position to supply it?
So the utility budget, CapEx budgets go up every single year. They update them. They do like a 3-year forward look, and it comes out, you know, January when they report, and the utility budgets, 3-year budgets are up 20%. It's an enormous sum. They're going to go up even more because the NVIDIA, AMD chips use a lot more electricity than the CPUs do. So there's even more pressure on the grid. So the cycle of, you know, improving the grid, building, you know, green type of utility structures, whether it's wind and solar or just upgrading what you have, is going to go on for a very, very long time. I'll just mention one stock that I've talked about before.
Please do.
You know, I mean, what do utilities do? They send you electricity and they send you a bill. But when they actually have to do something, they hire somebody to do it. So when you hear that utility A is increasing its CapEx budget and is building a solar or whatever, or a gas, whatever, 9 times out of 10 they hire a company called Quanta, which is the largest utility-related engineering company in the country. We've owned it for a long time. But what I would say the amusing thing is I'm on the quarterly call every quarter. And every quarter, the CEO looks happier. And you think, I couldn't look happier because he was so happy last quarter. But he's even happier today because he has so much business, he can't do it all.
That's the winner. Is there a loser? Is there a short for you, an active short?
I'm not talking about shorts.
No?
I mean, I do a little shorting for myself, but that's it.
Could you think of a theme, though, associated with that where there could be a group of companies that would lose in that world?
Well, I would say, just as an uber theme about companies that I probably would not invest in, are, you know, the stocks that did really well, call it 2018, 19, 20, 21, were the very high revenue growth, negative earnings companies. Kind of like public venture capital companies. Those got destroyed in 2022, down literally 75 to 90%. You know, they've come back, but you know, when you're down 75 to 90% and then you go up 50%, it doesn't look so good on a chart. I would just avoid those companies until it becomes very clear that they actually have real business models where they can actually make money.
In just a moment, we'll catch up with our analyst at Bloomberg Intelligence on the Walt Disney Company. That stock is down by about 5% this morning. Can we squeeze in a question on Marvel?
Yes, we can.
Which you have some expertise.
I do.
This conversation could go a whole lot longer than maybe we needed to.
It could go for hours.
What do you think is the
just as a
problem with the
background,
franchise, please?
I'm going to brag a little bit. I own one of the largest digital comic book collections on planet Earth. It's 11,000 comics on my iPad.
Wow.
And I've read all 11,000. So I could write a dissertation on Doctor Strange that would go for 200 pages.
Bob Iger
literally.
might read it.
Yes, you probably would. It'd be very interesting.
Maybe they should make it into a movie.
So the problem with Marvel movies, to me, is that they had a great story, and it ended. And Iron Man is dead. Captain America is 90. And Thor and this really upsets me, and I'm serious about this. They made Thor into a comedic buffoon, and it was always one of my favorite comics. So Thor being a comedic buffoon, I find extremely upsetting.
This is Hemsworth.
Yes, and there's no story anymore. They had a story where they had all these different tangents, but it all wove down into one eventual story, and then it was over. And they have been unable to find a new story. And the problem is that their three great characters are gone. So even if they had a story, who would want to go watch?
Steve, this was
I would
great.
just say, just as an example, the last Guardians of the Galaxy movie was unwatchable.
Steve Eisman with his Walt Disney review. Steve Eisman of Neuberger, Berman. Steve, this was great. It's good to see you. I'm pleased to say that joining us with his view on things is Mark Zandi of Moody's Analytics. Mark, it's been too long, sir. Thanks very much for catching up with us this morning. Why is the concern, in your words, around inflation being above target? Why is that concern misplaced?
Well, I think inflation's at target, appropriately measured, at least underlying inflation. I think if it's very problematic measuring the cost of housing services, particularly owner's equivalent rent. And if you look at harmonized inflation, exclude OER, we're there. And we've been there for quite some time. So, I think the Fed should be focused on the underlying rate of inflation, trying to abstract from the vagaries of the data, the ups and downs and all around. That's why they look at core, excluding food and energy. But at this point in time, I'd also exclude OER. And if you do that, we're there. We've been there for 6-9 months. So to me, it feels like the Fed has achieved its goal, its mandated. We're at full employment, sub 4% unemployment, and we're at target on inflation. And inflation expectations are nailed down to that 2% target. So I think, to me, everything's pointing green for the Fed to start cutting rates here.
Why do you think they don't talk about it in the same way?
I think it's a matter of credibility. I think they said, look, this is our number. We're looking at core consumer expenditure deflator. That's our target. That's the benchmark we're using for underlying inflation. We said we're going to get to 2%, and we're going to get there because they want to ensure that they are credible going forward. I get it. I understand that, and that's why I don't think they're going to move until later in the year, probably around September. That seems like the most logical point where they'd start cutting rates. But they are running a risk by doing so. I mean, it keeps. I do think the federal funds rate target at 5.5% is high, and it's putting a lot of pressure on the banking system, financial system, and broader economy, and they run the risk of breaking something. So they're taking a chance here, but I think at the end of the day, they want to make sure that they did what they said they're going to do. They're going to hit 2% on the core PCE deflator.
Mark, if Tom were here, he would say, let's rip up the script, because I'm getting a lot of hate mail from people who might fall into the the deficit camp. And we did just have Steve Eisman on. And he basically said all the concern, the gloom and doom about the U.S. deficit is what we've heard for the past 30 or 40 years of the deficit at everyone's kitchen table. And it won't really matter, doesn't matter for now economically. Do you agree, or do you think that the deficit is actually an economic concern going forward for this government at a time where we could be heading into potentially a less positive growth scenario than what we've had?
Yeah, I think it matters. The deficits and debt matter. I mean, when the reason what happened in the past, we said because all if we didn't change something, then we would have a problem. But we changed something. If you go back and look at previous historical points where the deficit debt were becoming a real issue, like the early mid 1990s would be a good case study. we responded collectively. We came together and we did what was necessary in terms of taxes and in terms of spending to rein it in and put things on a more sustainable path. Here we are today. Right now, I don't think deficits and debt matter, but look at the forecasts, and I think the forecasts are pretty reasonable. Take the Congressional Budget Office forecast, the nonpartisan group that does the budgeting, and if we don't change something, the debt to GDP goes from 100%. And by the way, that's a lot higher than it was 25 years ago. 25 years ago was about half that, so we're at 100% debt to GDP, and all the trend lines look pretty bad. So we should say, we got to change this, and hopefully we come together and change it. But of course, in the fractured political environment that we live in, it just feels like that's going to be a pretty heavy lift.
Which raises a question, at what point it becomes reality? People have worried about it for a long time, but it's not going to be reality until yields actually materially shift higher in a way that's punitive for the U.S. government and that speaks to some of these concerns. Do you see that on the horizon? Do you have a sense of what that rate would be, where it becomes unduly punitive to the U.S. government in terms of interest expenses and where that takes money away from?
Yeah, we're already, it's getting a little uncomfortable, right? I mean, if you look at interest payments, the federal government's interest payments, I think it's over $1 trillion now annually. And that's, I think we just passed the amount we spend on defense. And that's the first time I think that's ever happened, right? I mean, that feels weird. I mean, we're spending more on interest payments on our debt than our own national defense. So I think, pressure is starting to rise. But, here's the thing. I don't think the deficits in debt are a cliff event. It's not like you come up to a cliff and you go over. It's a corrosive on the economy. And as debt levels continue to rise, interest rates will continue to rise. A lot of empirical work trying to understand what the relationship is, but here's a good rule of thumb. For every percentage point increase in the debt to GDP ratio, so you go from 100% debt to GDP to, say, 110%, that adds a basis point. So you go 100 to 110%, that adds 10 basis points to that 10-year Treasury yield. That's not perfectly right, but that's roughly right. And the other thing I'd say is, jargony, it's nonlinear, meaning going from 100% debt to GDP to 110 is one thing. Going from 150 to 160, that's a totally different thing. So, I don't think, at least for the foreseeable future, we've got a cliff ahead of us, but this is a corrosive on our economy's ability to grow.
Mark, I want to ask you about the labor market because you mentioned how we are running a tight labor market. The Conference Board recently came out and consumers were less concerned actually about inflation. They were concerned about cracks in the labor market. Is it concerning to you when you look through this data? I mean, the last survey, the response rate was 54.9%, lowest since 2002.
You mean the survey rate? Survey you're asking about?
Do we have the correct read on this data?
Yeah, no, it bothers me. Yeah, and it's getting worse and worse. And, if you go look at the other I think the JOLT survey, the Job Opening Labor Turnover survey, we're down to like a third of respondents, getting back. So absolutely. And this goes to, it's a broader point. All the surveys that we look at and all the polls that we're looking at, they're increasingly less reliable. So yeah, I think this is a big problem, and why alternative data and third-party data sources are becoming more important because we can't rely on the surveys. They're just much, particularly month to month. This gets to the inflation persistence in the first quarter. Yeah. That's just a bunch of, in my view, technical factors, residual effects, and perhaps survey issues, seasonal adjustment issues. So it just complicates using data the way we have been using data month to month to set, for example, monetary policy.
Mark, we'd love your view on immigration as well. This has been a big theme over the last few months. And some people, in fact, quite a few guests on this program, basically saying wages have stayed low, even with these really decent, tremendous payrolls figures because of immigration. Mark, do you see it in quite the same way?
I do. I mean, there's obviously the immigration and what's going on at the southern border is a real challenge for a lot of communities across the country. But the one clear benefit, and particularly in this point in time when the labor market is very tight and business has been struggling to find and retain workers, is the surge in immigration. And there is a real clear link between immigration, where those immigrants are going, if you look across industries like leisure and hospitality or retailing, and wage growth in those industries. So I think we can connect those dots, and I think this has been very important. So it allows this immigration allows the economy to grow more quickly, and at the same time take pressure off of inflation. So I think been particularly fortuitous and really important. And if there's one thing we can do to address our long-term fiscal problems, it would be to have a rational immigration policy. Because if we can have more immigrants and the right kind of immigrants, immigrants that can really power economic growth, then that's going to solve a lot of problems, including our long-term fiscal problems. And we won't say oi. We won't have to say oi. We've got to cut spending and raise taxes. We got a stronger economy that's generating those tax revenues that we need to finance our government.
I like how that's catching on. Mark, I do just want to finish on this question. It's an important one. If it is important for what's happening in wages in very specific sectors and industries, what happens if border encounters drop, which they have? Based on the information we got yesterday, they've dropped by quite a bit. What happens next?
Well, the labor market's going to tighten up and it's going to put pressure on wages unless we see continued moderation in demand. And I think we will. I think that will happen here because interest rates are high. That 5.5% funds rate target, I do believe, is restrictive, and it becomes more restrictive over time. I mean, one reason why it hasn't bit really hard so far is that households and businesses did a really good job locking in the previously record low interest rates. But that only works for a period of time. As more households and businesses face higher interest rates, they're going to start to pull back. So I think the economy will slow, and even with less immigration, I think the Fed will be in a position to cut interest rates here very soon.
Mark, this was interesting. Always good to hear from you. Mark Zandi there of Moody's Analytics. Oi is catching on. You notice that?
Good.
Oi.
Yeah. We don't have to say oi anymore, according to him. Mark Zandi.
Hugh, wonderful to catch up with you once again, sir. I want to begin, if we may, talking about the theme park business and the consumer price tolerance that you see. Do you still have that pricing power at a time where many companies are reporting that, yes, there is upper-end stability, but maybe some lower-end fragility around the consumer?
Yeah, good morning. Great to be with you all. Yeah, I actually believe we do. If we sort of zoom out a little bit, the quarter was really a strong one for us. 17% OI growth, 30% EPS growth. That's what led us to raise guidance to 25% EPS growth for the full year, which is obviously quite strong. Two big stories, I think, here. Number one, you were just talking about our experiences business was up 10% on a revenue basis, 12% on an OI basis. And the parks business was actually up 13% on OI. So we do feel good about that. Obviously, I watch other stocks report and have seen that the value consumer is really struggling a bit and making choices right now. We're not really seeing as much of that in our portfolio of products. The other positive for us is obviously the streaming service. Last year, we lost about $600 million. This year, we're about break even, and we saw a 12% revenue growth. So we're encouraged by the progress we've made in that business in a relatively short period of time.
Hugh, you said that you're not seeing that kind of price sensitivity. How much could you increase prices then from here?
It's a great question. We took prices up a little bit in the beginning of this year and didn't really see much of an impact. So as to what the future brings, we're obviously very judicious with the way that we price. We want to provide access to as many guests as we possibly can. But we do believe that the great experiences we provide, people are willing to pay for.
Hugh, let's talk about the streaming business just a little bit more, and more specifically, if we can, Hulu. I want to get into Hulu and the future of that business. Can we just start with something like the likes of Taranaga and Shogun on Hulu? Hugh, how impressive that content actually was. When you have something like that, a big hit, how does it translate into gains for the company? How does it fall to the bottom line?
Yeah, it really does create two things. Number one, it brings new subscribers in, right? We call them first subscribers. Those types of shows do pull people into the service. And then once they're into the service, they realize just the great amount of content that's out there, so that those shows also tend to increase stickiness over time. So from both perspectives, they're truly additive. And the other piece of it that's terrific, I think, is it really does integrate well with the linear business as well. So, we use these different windows to choose when to show things, whether it's on FX or whether it's on ABC and then into the streaming service. So we're actually getting quite good at reaching different audiences, streaming being a bit of a younger audience, the linear business being a bit of a more mature audience, it gives us the ability to reach the most people, which is obviously terrific from an advertising and a subscriber perspective.
That sets up brilliantly the conversation about the future of Hulu, Hugh. So let's talk about it. A report yesterday from Reuters that JP Morgan has valued the company for you at close to $27.5 billion. Morgan Stanley valuing Hulu for Comcast at more than $40 billion. Is that an accurate assessment of where things are? They also reported that we're looking for an independent valuation now to try and close the gap. Could you just update us and tell us if that's an accurate representation of the current state of affairs?
Yeah, so we have a well-defined process in terms of how this is going to play its way out. Beyond that, I'm not going to comment on that right now. One of the disciplines I have is I talk about M&A when it's done, not before it's done.
Too early to talk about a timeline, Hugh?
A little bit too early.
So, Hugh, let's talk about going forward from here, where the big opportunities are for the streaming business.
Look, I think there are a multitude of opportunities. Number one, great programming. And that's an advantage that we have in our Disney portfolio because we create so much of our own IP. Number two is driving engagement. And bundling clearly does that, whether it's with sports, whether it's down in Latin America, we're actually putting sports, general entertainment, and Disney Plus together, or the tile that we added, the Hulu tile on Disney Plus. So that bundling is clearly an opportunity. Third is password sharing. That's an opportunity for us. We think it's pretty substantial and it's going to drive growth. Fourth is distribution cost. We do think by going direct to consumer, we can actually both build a stronger relationship with the consumer and also reduce our costs. And then fifth is technology. Clearly an opportunity in terms of recommendation engines. As we put all of that together, we're pretty well convinced that this is going to be a great growth business for the Disney company for a long, long time.
Hugh, you mentioned a number of things there, including password sharing. How much do you expect all of those initiatives you just mentioned to save money? What's the cost benefit of all of that?
Yeah, I mean, things like password sharing obviously drive additional revenue growth. Things like distribution costs do save money for you. In addition to that, things like recommendation engines and direct-to-consumer marketing tends to reduce churn, which allows you to reduce marketing costs. So there really is some synergy between the revenue benefits and the cost benefits. But overall, look, we're looking to make this into a great business, not just a growth business, but a great margin business for the company as well.
Hugh, over the past 6 months, we've been talking about the cost-cutting operations in Disney. Have we finished some of the shrinking? Have we finished the paring back? And are you back on some sort of growth trajectory?
We are definitely back on a growth trajectory. That said, we're always going to be looking hard at our cost structure, in particular looking to reduce costs where perhaps they add less value than they used to, and redeploy some of that money back into the business so that we can actually grow the balance of the business. So I think that's a never-ending exercise of looking for ways to be more efficient as a company so that you can invest in your future.
When you talk about growing, where is that growth focused on geographically? We know that in the U.S. you've got a very strong parks business. In Europe, there also is a parks presence, but in Asia, in particular in China, that has been a growth area. Is it still, how much can that be a bright spot at a time of increasing geopolitical tensions?
Yeah, I do think not just China, but all of Asia represent growth opportunities for us, both in terms of the streaming service in select markets, as well as in terms of the parks and cruises business. So we do see good growth opportunities there. Europe and Latin America continue to be good growth opportunities. And make no mistake, North America, we're not done growing yet. We still think there are terrific opportunities here for us right at home.
When it comes to Asia Pacific, is it domestic demand within those countries, specifically China, or is it tourists in the region?
Combination of both. I wouldn't tie it to one or the other. I think it's a combination of both.
And when you look at China, to Lisa's point, you know, we're going into a very heated political election coming up in November, very hot rhetoric regarding China. Is it becoming more challenging to deal with authorities in Beijing and business on the ground, given the increased geopolitical tensions?
It has not been for us. You know, one of the benefits of what we do for a living is, you know, we make people smile. We bring them happiness, right? We bring them those the most magical place on earth. Candidly, the government's investing in infrastructure to make it easier for guests to get to and from the park. We're continuing to invest in that park in order to drive growth. It's doing better now than it ever has. So we're the fortunate beneficiaries of bringing people joy in a world that needs it.
Hugh, we've got to talk about the NBA deal as well. Can you talk to us about that? And if it is going to be much higher, how do you make money from something like that? I just want to understand the numbers business of all of this.
Yeah. So the NBA, we're in the middle of discussions right now. So again, I don't comment on specific deals until they're done. What I would tell you is two things. Number one, we've had a long, productive relationship with the NBA. We've benefited from it, and clearly the NBA has benefited as well. I expect that that'll continue. Number two, we'll always continue to look at the balance of our rights portfolio, and as things come up, we'll decide whether we want to continue with them in the current form, reduce them, or even in some cases perhaps not continue to carry them anymore. So I think we'll balance the portfolio of rights, and we'll get the things that we need as the 35% market shareholder in the sports business to continue to make ESPN the true leader in sports.
Hugh, you said you won't comment on deals until they're done, but maybe you'll comment on other people's deals. Can we do that? Sony, Paramount. How would that impact Hollywood? Is that something you'd oppose?
It's funny. I don't have a real comment on that one.
I didn't expect you to, but we have to ask Hugh. We've got to leave it there. It's good to catch up, sir. Hugh Johnston there, the Disney CFO.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.